Welcome to another presentation at the East Trade Winds, hosted by Bernie Franzgrote and Wayne Pratt. The presentation today is titled Embrace Opportunities, Discover Wealth Strategies. Our guest is Michael Lautru from Parvis Investment. Are you unsure how to grow your wealth safely beyond your business? Michael helps people invest in private markets with trust and care. With over 10 years of experience, he knows how to build smart, goal-focused portfolios. Michael believes success comes from real human connections, not just numbers. He's here to help you reach your dreams and create a future you can be proud of.
I've been in research and development for the government in a few different capacities. My original background's in biochemistry as well as chemical engineering, but then eventually I ended up in finance. So it's the old adage, you never really end up where you studied it. In my case, it was health related, so I had to find a new interest, and finance and being an entrepreneur is one of those things that I think my father ingrained that into me. He's the one that really put it into my mind as a child, being on the road all the time with him. He was an owner operator for AMJ Campbell Van Lines, so got to learn a lot on the road driving trucks. How I learned to drive, like I learned to drive an 18-wheeler before I actually learned to drive a car. So that was pretty exciting. And the most flat part of Canada in Saskatchewan, at least that way, if you go off the road, you just end up in a field and you just keep going. It's not a big problem. But that being said, the reason I was invited to come and speak today was to share a little bit of the work that I do and how that can benefit yourselves or people in your general circles. So for the last 10 years, I've been in the private capital market space, a little known space for most investors, as typically it was a space that was generally reserved for people that were more affluent, and we call it accredited investors. Although over the last several years, securities regulators have not loosened up the rules. They've allowed different categories of investors to participate as well in the private capital space, barring certain restrictions and making sure that the investments that they are investing in are suitable for them. So that's where I come in as a dealing representative and advisor. My role is to make sure that investments that investors are looking at are suitable from that perspective and do fit their profile from a risk perspective, liquidity, and just generally their entire timeline. So I come in more as a strategist, where I'll help people. I'll take a look at their current portfolio and see what kind of changes they would like to see in their portfolio overall, and then basically put those into action. So I typically surround myself with a team of people, depending on the size of a portfolio, because at the end of the day, as you start growing those dollars and they grow to a substantial amount, you might want to consider building an incorporation for those investments versus doing it through your personal name, unless you're doing it strictly through RSPs or TFSAs. At that point, you require some tax planning and tax strategy as well. So I work with some pretty affluent and very successful tax planners who used to be forensic auditors for CRA, so they know what they're doing. And then I'll also work with portfolio managers on the public side, because as much as the private capital markets are really great to invest into, I would never expose any one investor to more than a certain percentage of their portfolio to the capital private markets, strictly on a liquidity basis, because for the most part, once your capital is deployed, it takes time to get it back out. So hence I'll focus on cash flowing assets that do pay on a monthly or quarterly basis, so that you don't actually need to pull capital out initially. But if you do, there's a process. So it's not as quick as the stock market. However, being that most of the assets we invest in are boring, you don't have the volatility that the stock market has either. Meaning that your dollar is not a dollar today and then 50 cents tomorrow. It's a dollar today and $1.10 the next day, and just keeps moving up, sometimes slower, sometimes faster, but very seldom does it ever go backwards. I represent a company named Parvis. Parvis has been around now for a couple of years here in Canada. They're relatively new to the exempt market space. Prior to that, I was with Pinnacle Wealth Brokers for approximately 10 years, where I cut my teeth. But Parvis itself, they're technology driven. Being in the space, they wanted to democratize the entire private capital market space to allow more access for investors and a lot more transparency when it comes to the actual deployment of documentation, so people can actually learn about what they're investing in, because that's one of the caveats with the private capital space. You don't have all the access to the information right away until you're fully engaged as an investor, or you're basically, you call the issuer directly. Even then, they don't normally always give you all the reports. So we act as that reporting standard for people to be able to get access to all the information they need to make those informed decisions. So we bring institutional style investments to the table for investors to participate in. Some investments require slightly larger commitments, others are lower. It really depends on the type of portfolio and what you're looking for. So overall, you can see we have, if you look at the pictures on the slide, depending on the type of opportunity you're looking for, returns can range from 8% and upwards of 30. Again, that boils down to how much risk are you willing to take? Because all that to say, even though private capital markets are on the boring side, there is risks involved. And yes, sometimes things can go sideways or make less than you were expecting. I've only seen a handful of private capital investments blow up. Thankfully, I was never involved with them because when I look at the different assets out there that are available, I am very diligent myself. And when something doesn't really look, not that it doesn't look right, but it doesn't, from my perspective, if it's not boring enough, I typically stay away. And I'm glad I have, because at the end of the day, when people offer or promise really high returns based on certain asset types, I ask a lot of questions. And if I don't like the answers, then I don't get involved. But with Parvis, the platform, because it is fully digital, it helps broaden our access. Happy to hear that you guys are getting clicks in the United States, simply because we do have offshore banking to allow international investors to invest into Canada without being hit with the tax burden of Canada. They're just hit with the tax burden of their originating country, but they're able to invest now into Canada through our platform. We follow strict legal and compliance, lots of rules in place in the security space, mainly to protect investors. Because at the end of the day, we don't invest money to lose money. They invest money to generate profits and then also help to roll the economy in Canada here. So through the platform, I build up your investor profile, and then we build customized strategies through there. And then that way you can see from a visibility standpoint, all the different investments that are out there and available to you. It's very cost efficient and transparent. The only cost typically that investors will see directly is if they're using a trustee account in order to be able to leverage their RRSPs and TFSAs. Otherwise, there's no cost to investors to use our platform or my services as an example. Any fees paid are done through profit share from portfolios and is already equated in the offerings operational fees and costs, basically. So investors never actually pay out of pocket. So there's no front end fees, no back end fees. The only time that you might get a penalty is if, say, you invested today and you did need your money out before a certain time frame. Sometimes there's penalties there, but for the most part, again, that's where I come in, where I determine what your time frames are like, and then I place your money adequately so that you don't have to worry about that aspect at all. So lots of opportunities out there, mainly real estate. Parvis focused a lot in the real estate space when they first got started. I've been slowly getting them involved in other asset classes that are just as boring as real estate, such as industrial services and infrastructure, because we always need lots of that. You can't build real estate on top of farmland. You need infrastructure in place to be able to keep building those houses and those buildings. So always new portfolios coming into the pipeline. These are just a few examples of what we've worked on in the past. So the reason that Parvis came to be, I mentioned a little bit earlier, is really to democratize the access to the private capital market space, offering investors diversified opportunities with strategic growth so that they're able to fully leverage all of the investment opportunities out there in order to make their entire portfolio work that much better for them. So I work closely with existing advisors. If the investors already have an advisor in place and their advisor is allowed to work with someone like myself, sometimes they're not. In the mutual fund space, technically they're not allowed. So they're not allowed to refer anybody to me, but it doesn't mean that investors can't approach me themselves. However, when it comes to full portfolio strategy, when an advisor is allowed to work with me, then we can properly strategize the full portfolio in order to make sure that investors aren't overexposed to one asset class versus another or any one kind of risk factor. Full round balanced approach, similar to CPP. CPP, they do pretty well overall. And if you look at it, their portfolio is 60% private capital, which is pretty impressive. It used to be 5% approximately 15 years ago. And the reason they started making that switch is because boring businesses make money. They actually just keep generating income and cash flow on a very consistent and reliable way. Platform itself is very easy. You give me a call, you say, Mike, I'm interested in learning more about these different investments. All I need is your name and your email. I plug it in, I send you a link, you fill in a profile, and then we have a chat. And then we look at the different opportunities out there. Basically, I get a full snapshot from yourselves as investors to verify and just to see where you stand and what you would like to do with the future of your portfolio. And then we strategize from there. Some people take small steps, others take big chunks right out of the gate. It really depends on your appetite and what you'd like to see from your portfolio moving forward. And there's always new projects coming online. Every now and again, you'll get an email saying, oh, we have something new. If it's something that interests you, same thing, you just click on it, give me a call, and we go over the details. Because again, the devil's in the details. Sometimes you see a great big return number, but then I explain why it's a big return and the possibility of it might be quite so big depending on a lot of different factors. Development projects typically give really good returns. However, if development projects go too long, your returns decrease slowly, although you'll still make good returns. It's just that it won't be as big as you were expecting. So we have different profiles customized for investors. Returns vary anywhere from 5% all the way up to 27 plus. It really depends on how balanced you want your portfolio to be. So you can a little bit of money in more aggressive things and then the rest in more really boring things that just pay on a monthly basis. We work with a lot of mortgage investment corporations. So there doesn't get much more boring than that. Mortgages are one of those things that as long as people are paying their mortgage, you're making money and you're helping people stay inside of a home. So lots of things like that. This is me, obviously, but I work extensively with the government and business development, and then eventually ended up in finance. Always happy to join people for a coffee. And I just wanted to briefly touch on the boring business of real estate, generally speaking, just because real estate, especially in the private capital space and in residential real estate particularly, and this also applies to self-storage real estate. Overall, you get much higher risk-adjusted returns in the private capital space within the real estate space, as long as obviously you're working with a reputable real estate trust that's well managed. But typically, if you look at the overall market right at the bottom here, overall, if you notice, there hasn't been a time where the private real estate market has gone below zero. So if you look at the different other types of investments out there, especially in the equity space, which I've worked in as well, also invested in the equity space, but all that to say, when you have large fluctuations within your investment portfolio, it can make for a pretty bumpy ride. As you get older and closer to retirement, you want something that's not going to be moving so much and has very consistent rates of return without going into the negative space. Because every time your money goes negative, it has to work 2 to 3 times harder just to get back to where it was before actually making a profit again. So low volatility versus risk. So here you have private Canadian apartment REITs. They have a 10 to 11% overall rate of return, traditionally with basically lower volatility than a Canadian bond. It's pretty secure. But at the end of the day, it's safer for you as an investor to own several doors of apartments than it is to own your own home. Because at the end of the day, you're not leveraging your investment dollars into those doors, but you are leveraging money for your home. You typically get better returns versus US equities and Canadian equities, which are much, much higher risk. You get similar returns, but you have to expose yourself to a lot of undue risk in order to get that. So all that to say, boring real estate makes money. You keep it a little bit in the public space, but I mainly keep assets in the public space from a liquidity perspective because it's easy access. If you need to sell something off quickly to get some money out, the public space is a key there. Although there's some mortgage trusts that also allow redemptions after 1 year. So here's a perfect example of what I mean by when your investments don't go below zero. So everyone remembers 2008 when the US decided to play games with the real estate market, and that what happens is in the public space with the stock market, everyone is quite emotional. And even though the underlying value of real estate on a large scale doesn't really fluctuate, I mean, between all of us and the fence post, I'm sure we can agree that the value of an apartment building doesn't fluctuate 40% because of mortgage rates. It just doesn't happen. But what happens is in the public space, because people buy and sell shares, the value of your share fluctuates because of that aspect. Whereas in the private space, you don't have that volatility because you don't buy and sell shares when you're buying into a limited partnership for a building, let's say. Because once your money is invested in a building, the purpose of that money being invested there is to generate recurring income from that building. It just doesn't work that way. There's a longer process than that, hence why you don't have that volatility. So 2008, the private real estate market did a 6% return, which wasn't the best return it's ever had, but it's definitely better than minus 38, which was the public real estate market. So someone that was retiring that year and heavily invested in the public space was having a really bad day. So a lot of the people I tend to work with are retired business owners, and they're very happy that I manage a large portion of their portfolios in the private space because they don't have to worry about that those huge swings in volatility. They know the money will be there when they need it. And then another thing is they're more tax efficient. Real estate trusts in the private side, especially when you start doing proper tax planning, you require less money invested to generate the same amount of income. So for example, if you were to peg it at, say, an average 6% return with $100,000, you're generating $6,000 a year. To generate that same $6,000 a year after tax with preferred shares, you would need $140,000 invested. And same thing with GICs, bonds, and everything else. You need almost $200,000 to generate that same $6,000. So very tax efficient. Again, that's where I surround myself with a team for you when it comes to building these things out, because at the end of the day, the more money you keep in your pocket is really where it matters and what counts. Because then you don't have to live in the north and suffer through winter. You can fly south and still make the same money or better without paying all those crazy taxes. It's a development in Mont Tremblant. I thought I'd put that up there just to give you an idea of the different types of assets that I do work with, because Tremblant is a nice place, very touristy. They're building some pretty nice luxury condos and that. It's almost fully funded now, and I think they're just doing a final close in July. That's one aspect. But then there's also, if you want to get involved in all sorts of aspects of real estate, we work with portfolios that do the supply management of all the materials for construction. So KV Building Products, they supply over $1 billion in building materials to projects across Canada. And then we have the Mini Mall Self-Storage Trust. That one there is about as boring as it gets. But for those of you that might not know this, self-storage can be very lucrative, low overhead, easy maintenance, and the percentages just keep rolling in. It's pretty straightforward, boring, and makes money at the end of the day.
Unlock the full potential of networking with East Trade Winds. Are you eager to connect with our esteemed guest speaker and delve deeper into the ever-expanding universe of connections? Simply scan the QR code now and embark on a journey of endless opportunities. Join us at East Trade Winds, where we gather online via Zoom every Tuesday from 8 to 9 a.m. Eastern Standard Time. Whether you're a seasoned professional or just starting out, you're welcome to connect with us. Seize the moment, register for free, and start exploring today. Fancy sharing your insights as a guest speaker? We're looking for you. Reach out to Wayne Pratt to ignite your speaking journey. Email him at wayne@motivateyou.ca or connect with Wayne on LinkedIn. Don't wait. Take action and be a part of a global community that's shaping the future of business networking.